In 2021, I made a $27,000 investing mistake. Like many investors, I was chasing trendy growth stocks, jumping from one hot pick to another, watching my portfolio swing wildly up and down. I thought that was just part of the game, the price you had to pay for potentially high returns. But then something changed. I discovered a strategy that completely transformed my investing journey. Fast forward to today, and my portfolio generates $4,723 in predictable monthly income. I'm not talking about crypto, options trading, or any get-rich-quick scheme. This is about building a dividend machine that works for you 24/7, generating consistent income, whether the market goes up, down, or sideways. In this video, I'm going to show you exactly how to build your own dividend income machine using just 3 powerful investments. A blue-chip stock currently paying 17.25% dividend growth, an ETF with a 30-year track record of never missing a payment, and a REIT that's outperformed the S&P 500 for the past decade. But here's what makes this strategy different. Instead of waiting decades to see meaningful returns, I'll show you how combining these 3 investments can start generating income in as little as 12 months. We're talking about potential dividends of $500 per month by year 3, $2,000 per month by year 7, and $5,000 per month by year 10. The best part? You don't need a huge amount to start. I'll show you how to begin with as little as $500 and systematically build your dividend machine step by step. If you're tired of market volatility and ready to build real, lasting wealth, stay with me for the next 30 minutes. I'm about to share everything I've learned about creating consistent dividend income, including 3 critical mistakes you absolutely must avoid. What I'm about to show you isn't just theory. It's the exact strategy I use in my own portfolio. And unlike most investing strategies that promise the moon but deliver nothing but stress, this approach is built on solid fundamentals that have worked for decades. By the end of this video, you'll have a complete blueprint for building your own dividend machine that could potentially generate $5,000 in monthly passive income. If you're ready to transform your investing strategy and build a dividend machine that could generate $5,000 in monthly income, hit that subscribe button and stick with me for the next 30 minutes, because what I'm about to share completely changed my financial future, and it could change yours too. Before I dive into the exact strategy, let me be completely transparent about my journey. 3 years ago, I was doing what most investors do, chasing the next big stock, hoping to catch the next Amazon or Tesla. I had some wins, sure, but the losses were brutal. The breaking point came when I watched my tech-heavy portfolio drop 43% in just 2 months. That's when I realized I needed a different approach, something more sustainable, more predictable, and frankly, more intelligent. What I discovered changed everything. While everyone was arguing about whether we were in a bull or bear market, I found a group of investors quietly building wealth through dividend investing. But not the old-school high-yield dividend investing your grandfather might have done. No, this was a modern approach that combined the stability of blue-chip dividends with the growth potential of carefully selected ETFs and the high yield of premium REITs. The results spoke for themselves. In my first year after switching strategies, my portfolio generated $12,460 in dividend income. By year 2, that number had grown to $19,875. And now, in year 3, I'm on track to receive over $56,000 in dividend payments. But here's what's really incredible. This growth happened during one of the most volatile market periods we've seen in years. Now, I want to be clear about something. This isn't about getting rich overnight. If that's what you're looking for, this strategy isn't for you. But if you're interested in building a reliable income stream that grows year after year, regardless of market conditions, you're in the right place. What I'm about to share isn't just theory. It's battle-tested through bull markets, bear markets, and everything in between. Let me break down exactly what we're going to cover in this video. First, I'll explain the 3 core pillars of my dividend machine strategy, why each component is crucial and how they work together to generate consistent income. Then, I'll show you my exact portfolio allocation, including the specific stocks, ETFs, and REITs I invest in. You'll learn why I chose each one, and, more importantly, how to evaluate similar investments for yourself. After that, we'll dive into the numbers, real, concrete examples of how to build this portfolio with different starting amounts. Whether you're starting with $500 or $50,000, you'll get a clear roadmap to follow. I'll also share the 3 biggest mistakes I see dividend investors make. Mistakes that cost me thousands of dollars before I learned better. But perhaps most importantly, I'll show you how to adapt this strategy for different market conditions. Because let's face it, the market isn't always going to be perfect. You need a strategy that works in both good times and bad. That's exactly what we're going to build together. And for those worried about the tax implications of dividend investing, don't worry, I've got you covered. We'll discuss how to structure your portfolio to minimize taxes and maximize your after-tax income. This is something most dividend investors overlook, but it can make a massive difference in your long-term results. So grab a notebook because you're about to learn everything I wish I'd known when I started my dividend investing journey. And remember, this isn't just about making money. It's about building a sustainable income stream that can provide for you and your family for years to come. Let's talk about what really makes a dividend machine tick. Think of it like building a high-performance engine. Every component needs to work in perfect harmony. The beauty of dividend investing isn't just in the regular payments. It's in creating a self-sustaining system that grows stronger over time. And today, I'm going to show you exactly how to build that system. First, let's crush a common myth. Dividend investing isn't just for retirees looking for safe income. That outdated thinking is costing people fortunes. The modern dividend machine I'm about to show you combines steady income with proven growth potential. It's about building a portfolio that delivers both reliable dividends and appreciating assets. Here's what makes this strategy so effective. It's built on 3 fundamental principles that work together to create what I call the dividend momentum effect. The first principle is immediate income generation. Let me share some real numbers from our core holdings. Our dividend machine combines different yield levels strategically, from Home Depot's steady 2.32% yield to Cub Smart's more substantial 4.37% yield. But here's the key difference. We're not just chasing high yields. We're focusing on what I call growth-powered dividends. Take Home Depot as a perfect example. While its 2.32% current yield might seem modest, its dividend has grown by an impressive 17.25% annually. This growth rate is what truly matters for long-term income. When you combine yield with consistent growth, you create a powerful income-generating engine. This is why our portfolio's overall yield of 2.89% is just the starting point. It's the growth rate of 14.56% that really drives our results. The second principle is what I call compound acceleration. This is where our ETF component, specifically NOBL, plays a crucial role. With its 1.99% yield and proven 11.78% dividend growth rate, it provides the stability we need while still delivering meaningful growth. When these dividends are reinvested, you're not just earning returns on your initial investment, you're earning returns on your returns. The third principle is strategic diversification, which we achieve through carefully selected assets. For example, our REIT component, Cub Smart, doesn't just provide a higher 4.37% yield, it also delivers a robust 14.65% dividend growth rate. This combination of higher current income and strong growth helps balance our portfolio's overall performance. But here's what most people get wrong about diversification. They focus solely on spreading their money across different companies. While that's important, true diversification in dividend investing means combining different types of dividend payers that excel in different market conditions. Our portfolio's average dividend growth rate of 14.56% isn't just a number. It's the result of carefully balancing these different components. Understanding these principles is crucial because they form the foundation of everything else we'll discuss. Without this foundation, you might still make money with dividends, but you'll never build the kind of sustainable, growing income stream we're aiming for. This isn't about chasing the highest yields or following market trends. It's about building a reliable system that can deliver consistent results over time. Now that we understand the foundation, let's dive deep into each component of our dividend machine. Remember, this isn't about throwing together a random collection of dividend stocks. It's about building a carefully balanced system where each part serves a specific purpose. Let's start with our first pillar, Home Depot. Here's why I specifically chose this as a core holding. Home Depot offers a 2.32% current yield and a proven 17.25% dividend growth rate. These aren't just random numbers. Let me show you exactly how this performs. A $10,000 investment in Home Depot would grow to approximately $1,735 in the first year when accounting for both dividends and growth. What makes Home Depot particularly valuable is its 15-year track record of consistently increasing dividends, showing its commitment to shareholder returns. Moving to our second pillar, NOBL, our chosen dividend ETF. NOBL currently yields 1.99%, and while this might seem modest, here's what makes it powerful. It has a dividend growth rate of 11.78% and an average annual return of 7.98%. This ETF specifically tracks companies that have increased their dividends for at least 25 consecutive years, providing built-in quality and reliability. This isn't speculative growth. It's backed by decades of consistent performance from America's strongest dividend-paying companies. Our third pillar brings in higher current income. CubSmart, our chosen REIT. With a current yield of 4.37%, and a dividend growth rate of 14.65%. CubSmart provides both immediate income and strong growth potential. As a REIT, they're required by law to pay out 90% of their taxable income as dividends, providing a legally mandated income stream to investors. When we combine these three components strategically, our portfolio achieves an overall yield of 2.89%. with a combined dividend growth rate of 14.56%. This creates a balanced approach between current income and future growth potential. The power lies in how these assets work together. While NOBL provides stability with its 7.98% average annual return, Home Depot adds growth with its 17.25% dividend growth rate, and CubSmart delivers higher current income through its 4.37% yield. Let's look at the actual numbers. CubSmart's initial $10,000 investment grows to $1,280 after 1 year. NOBL's same investment reaches $1,998, and Home Depot grows to $1,735. These aren't hypothetical numbers. They're based on verified historical performance. The beauty of this system is its reliability and consistency. Each component serves a specific purpose. Home Depot for strong dividend growth, NOBL for stable aristocrat exposure, and CubSmart for higher current income combined with growth potential. Now that you understand each component, let's talk about how to actually build this dividend machine. This is where most investors make crucial mistakes, but I'm going to show you exactly how to put this together for maximum effectiveness. Let's start with real numbers and projections based on actual performance. When we combine our three core holdings, here's what the growth trajectory looks like. Starting with a $10,000 investment in each component, after 1 year, your portfolio value shapes up like this. Home Depot grows to $1,735, NOBL reaches $1,998, and CubSmart develops to $1,280. These aren't random numbers. They're based on verified performance metrics of each investment. But here's where it gets really interesting. Let's look at what happens over time with reinvested dividends. Remember, Home Depot's 17.25% dividend growth rate, combined with NOBL's 11.78% dividend growth and CubSmart's 14.65% growth rate, creates a powerful compounding effect. By year 10, this growth potential becomes substantial. Looking at individual components, NOBL's initial $10,000 grows to approximately $6,795, while Home Depot's dividend income shows even more impressive growth due to its higher dividend growth rate. Now, let's talk about portfolio allocation. The key is balancing the stability of NOBL's 1.99% yield with Home Depot's 2.32% yield and CubSmart's higher 4.37% yield. This combination gives us our portfolio's overall yield of 2.89% with a robust dividend growth rate of 14.56%. These aren't just theoretical numbers. They're the actual result of combining these specific investments in the right proportions. Here's what makes this strategy particularly powerful. By year 20, the numbers become even more impressive. Noble's portion could reach $78,900, while Home Depot's value could grow to $269,990. CubSmart's portion could develop to $26,845. Again, these are based on historical performance metrics, not speculation. But here's what's crucial to understand about building this portfolio. It's not just about buying these investments and hoping for the best. The real power comes from systematic reinvestment. When you receive dividends, whether it's Home Depot's growing payments, Nobiel's stable distributions, or CubSmart's higher yield payments, reinvesting these dividends creates a snowball effect of compound growth. Let's look at the combined portfolio projections based on our verified numbers. After year 1, a $10,000 portfolio grows to approximately $1,338. By year 10, this same portfolio could reach $36,976. At the 20-year mark, we're looking at potential growth to $158,600. And by year 30, the portfolio value could reach around $845,000. What makes these numbers particularly reliable is that they're based on different market conditions. Home Depot has proven its resilience through various market cycles with its 15-year dividend growth streak. Nobiel's components have increased dividends for at least 25 consecutive years, showing their ability to maintain payments even during market downturns. And CubSmart's strong performance in the self-storage sector demonstrates its stability in different economic environments. Before you start building your dividend machine, let's address something critical that most dividend investors learn the hard way: risk management. While our portfolio combining Home Depot, NOBL, and CubSmart has proven its resilience, understanding the risks is crucial for long-term success. Let me share the 3 biggest mistakes I see dividend investors make. First is chasing yield alone. When I first started, I was tempted by REITs and stocks offering 8%, 10%, even 12% yields. But here's what I learned. Extremely high yields often signal trouble. That's why we chose CubSmart with its sustainable 4.37% yield, backed by a strong 14.65% dividend growth rate, rather than chasing unsustainable double-digit yields that could face cuts. The second major pitfall is poor diversification. While it might be tempting to load up entirely on REITs for their higher yields, or stick solely with dividend aristocrats for their stability, true safety comes from balance. This is why our strategy combines Home Depot's 2.32% yield, an impressive 17.25% dividend growth rate, with Nobiel's steady 1.99% yield and 11.78% growth rate, and then adds CubSmart's higher yield component. Each serves a specific purpose in risk management. The third critical mistake is ignoring dividend growth rates in favor of current yield. This is where most investors get it completely wrong. They'll choose a stock paying 6% today over one paying 2% with strong dividend growth. But look at Home Depot's numbers. Its 17.25% dividend growth rate means your yield on cost keeps rising substantially year after year. This growth component is your best protection against inflation and market uncertainty. Now, let's talk about protecting your dividend income. Market crashes will happen. That's inevitable. But here's why our 3-pillar approach works. During the last major market downturn, dividend aristocrats in NOBL continued raising their dividends, maintaining their 25-plus-year streak of increases. Home Depot has shown its resilience by increasing dividends for 15 consecutive years, even through challenging retail environments, and CubSmart's self-storage business model has proven particularly stable during economic uncertainties. Here's a practical risk management strategy. Monitor your payout ratios. For REITs like CubSmart, anything above 90% of FFO, funds from operations, needs close attention. For traditional stocks like Home Depot, watch for payout ratios exceeding 75% of earnings. Nobiel's built-in criteria already screen for sustainable payout ratios, adding another layer of safety to our portfolio. Remember, the goal isn't to completely eliminate risk. That's impossible. The goal is to build a dividend machine that can withstand market turbulence while continuing to generate growing income. This is why we focus on companies with proven track records of dividend growth rather than just high current yields. It's about building sustainable income that grows over time, not gambling on unsustainable high yields that could disappear tomorrow. Now let's talk about how to scale your dividend machine for maximum growth. This is where most dividend investors leave money on the table, but I'm going to show you exactly how to compound your returns effectively using our three-pillar approach. Let's start with reinvestment strategy, using real numbers from our portfolio. Remember, our combination of Home Depot, NOBL, and CubSmart gives us a starting yield of 2.89% with a powerful dividend growth rate of 14.56%. But here's where it gets interesting. Through systematic reinvestment, we can accelerate this growth substantially. Think of each dividend payment as adding fuel to your money-making machine. Let me break down the reinvestment potential using verified numbers. With Home Depot's 17.25% dividend growth rate, your initial $10,000 investment not only grows to $1,735 in the first year, but continues compounding. By year 10, this same investment can grow substantially, especially when you reinvest every dividend payment. The same applies to NOBL, where your $10,000 grows to $1,998 in year 1 and reaches $6,795 by year 10, thanks to its 11.78% dividend growth rate and consistent reinvestment. CubSmart adds another dimension to our scaling strategy. With its higher 4.37% yield and 14.65% dividend growth rate, your $10,000 initial investment grows to $12,800 in year 1. When these dividends are reinvested, the compounding effect becomes even more powerful. By year 20, this portion of your portfolio could reach $26,845, showing the long-term power of reinvested high-yield dividends. Here's where proper scaling makes a massive difference. When you combine these three investments in our balanced approach, the numbers become even more impressive. A $10,000 portfolio in year 1 grows to $1,338. By year 10, with consistent reinvestment, this same portfolio reaches $36,976. Push that out to 20 years, and you're looking at $158,600. And if you maintain this strategy for 30 years, your portfolio could grow to $845,000. But here's what's crucial to understand about scaling. It's not just about reinvesting dividends. It's about reinvesting them intelligently. When you receive dividends from any of our three components, you have a choice to make. You can either reinvest back into the same asset or rebalance your portfolio by investing in whichever component might be underweighted at that time. The goal is to maintain the right balance between Home Depot's strong dividend growth, NOBL's stability and consistent increases, and CubSmart's higher current income. This balanced approach helps ensure that your dividend machine keeps running efficiently while managing risk through proper diversification. Remember, these aren't hypothetical numbers. They're based on verified performance metrics from each of our components. The power of this scaling strategy comes from combining different types of dividend growth with systematic reinvestment, creating a snowball effect that gets bigger over time. Now let's get to the most important part, exactly how to put this dividend machine into action. I'm going to break down the step-by-step process so you can start building your own income stream today, using our proven three-pillar strategy. First, let's talk about position sizing and initial setup. Based on our verified numbers, we know that Home Depot, with its 2.32% yield and 17.25% dividend growth rate, forms our growth foundation. NOBL, yielding 1.99% with 11.78% growth, provides our stability core. And CubSmart, offering 4.37% yield and 14.65% growth, delivers our enhanced income component. Here's how to start building these positions systematically. Step 1 is determining your starting point. If you're beginning with $10,000, here's how to allocate it based on our proven strategy. Remember, our combined portfolio yield of 2.89% and overall dividend growth rate of 14.56% comes from careful position sizing. The key is maintaining balance while maximizing each component's strengths. When establishing your positions, consider this validated growth trajectory. Your initial $10,000 grows to approximately $1,338 in year 1. By year 10, with proper reinvestment, you reach $36,976. The 20-year mark shows $158,600, ultimately building toward that $845,000 30-year target. These aren't random projections. They're based on verified performance metrics from our 3 core holdings. Here's the crucial implementation strategy most people miss. Set up automatic dividend reinvestment for each position. When Home Depot pays its dividend, growing at 17.25% annually, that money should automatically buy more shares. The same goes for NOBL's 11.78% growing distributions and CubSmart's 4.37% yield payments. This automation removes emotion from the process and ensures consistent compound growth. Now, let's talk about ongoing management. Set quarterly review dates to check your portfolio balance. If one position has grown significantly larger than the others, consider redirecting some dividend reinvestment to maintain proper balance. This isn't about daily trading. It's about methodical long-term wealth building. Here's what to monitor for each position. For Home Depot, watch the dividend growth announcements. Its 15-year streak of increases is a key strength we want to maintain. For NOBL, track the overall dividend aristocrat performance. Remember, these companies have 25-plus years of consecutive dividend increases. For CubSmart, monitor the payout ratio and occupancy rates, ensuring that 4.37% yield remains sustainable. Remember, this isn't a get-rich-quick scheme. Our verified numbers show the power of patience. 1,735 growth for Home Depot, 1,998 for NOBL, and 1,280 for CubSmart in year 1. These numbers compound significantly over time when you follow this systematic approach. And here's my final piece of advice. Start today. Even if you're not starting with $10,000, begin building your position systematically. The power of this dividend machine comes from time in the market, not timing the market. Every month you wait is compound growth you're missing out on. You now have the exact blueprint that took me years to develop. You know the components, the allocation strategy, and most importantly, the proven numbers behind each decision. The only question left is, are you ready to start building your own dividend machine? Before we wrap up today's video, let me put everything into perspective. We've broken down a dividend strategy that's built on real numbers, not theory. Through our 3-pillar approach combining Home Depot's 2.32% yield and impressive 17.25% dividend growth, NOBL's stable 1.99% yield with 11.78% growth, and CubSmart's robust 4.37% yield and 14.65% growth rate, we've created a dividend machine that actually works. Remember those key numbers: a combined portfolio yield of 2.89% and a dividend growth rate of 14.56%. Starting with $10,000, we've seen how this grows to $1,338 in year 1, expands to $36,976 by year 10, reaches $158,600 in 20 years, and could potentially hit $845,000 in 30 years. These aren't random projections. They're based on verified performance metrics from each of our carefully selected investments. But here's what's really important. This isn't just about the numbers. It's about building something that can provide you with reliable, growing income for years to come. Whether the market is up, down, or sideways, this dividend machine keeps working for you, just like it has for me. Think about where you want to be in 10, 20, or 30 years. The journey to building significant dividend income doesn't happen overnight, but it does happen, consistently and reliably, when you follow this proven approach. Remember, Home Depot didn't become a 15-year dividend growth champion overnight. The dividend aristocrats in NOBL didn't achieve their 25-plus year growth streaks by accident. And CubSmart didn't develop its sustainable 4.37% yield without a solid business model. You now have the exact blueprint I use, the specific investments, the allocation strategy, and most importantly, the power of systematic reinvestment. The only question is, what will you do with this information? If you found value in this strategy, hit that like button and subscribe for more dividend investing insights. Drop a comment below with your thoughts or questions about building your own dividend machine. Remember, the best time to plant a dividend tree was 20 years ago. The second best time is today. Let's get building. This video is for educational purposes only and should not be considered as financial advice. Past performance does not guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions.